ended the last week with risk assets on offer, right? There's this whole narrative of, G10 FX or rates are still not quite done pricing in what could be more tightening. Are those themes likely still going to dominate the minds of investors for some time?
Yeah, I mean, if you think last year, the key component for the market was higher interest rates. And so it's still with us, and it's still the key component. And Powell was surprisingly hawkish in his statement, and we have seen the dot plots moving up, but I think what people have missed actually is not just the dot plots have moved up, they actually increased the core PCE expectation from 3.6 to 3.9, which is a clear indication that we might get higher interest rates. So we think July meeting is definitely live, and most likely we will see one hike.
So on balance, is that seems to be not constructive equity market-wise? What about fixed income, knowing that rates might move higher still, maybe even a little bit? Yeah.
Well, we are least preferred on equities. Now, our expectation was the market are more flattish, but now we have seen quite a big rally. We have heard NASDAQ, one of the best year. So far, we actually think there's some overvaluation in some of these stocks, and they actually should start to retreat, and there's a bit of downside at this point. The July meeting, we most likely get a hike, but we also will get more weaker macroeconomic data. We have seen PMI flash indicators coming out last week, significantly weaker. We also think there's a build-up, not just in finance or in tech when it comes to the employment market. We actually start to see that initial jobless claims starting to go up. So it's broadening out, and I think all these factors is lower growth, sticky inflation, higher interest rates. Doesn't sound like very compelling for equities, but makes it a bit more compelling story for fixed income at this point, as rates have probably priced in the higher increase in dot plots. And eventually, that will mean the Fed will also have to cut.
And how do you look at fixed income overall, that space now? Where do you still see, and what part of the curve, for example, you focus on? How far the spectrum do you look at in terms of credit, in terms of taking risk now, too?
Well, we do think the curve has to steepen. I think it's at this point highly inverted. So we like the 10-year Treasury at this point. So that's where we start to actually add duration to our portfolio. The 5-year space still looks interesting at this point. So we're buying high-grade bonds. We want to buy good quality bonds as we go into an economic slowdown. We also think that spreads are quite narrow, and that's probably where we start to see the first cracks. It's maybe not on the equity side, might be more on some of the credit spreads that will come through.
What about Europe? I mean, the Bank of England has told us, the market's telling us they're going to move more. The ECB has been just very clear about where they want to take interest rates. Fixed income in Europe, is it too early to be as bullish there as you are on Treasuries, as I heard you allude to?
Well, I think what we play more is the currency side. We actually think the US dollar is expensive. The Fed might be the first one to stop hiking interest rates. And we see the BOE way behind the curve. I mean, in inflation, and we see wage growth up more than 7% year on year. We clearly can see that they also were lacking in terms of communication ability. So surprised with a 50 basis points hike. We think they will hike another 75 basis points, which is quite substantial. And the ECB, we see that Europe, in particular Germany, sees some slowdown. There's some negative news coming through, but it seems the ECB is not done yet, and they probably have to go further. And I think that's the interest rate differential is narrowing. That should weigh on the US dollar.